Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stocks lower as investors wait a crucial week of data. Alastair Pinder and the team at HSBC setting their 2026 S&P 500 target at 7,500, writing, AI has carried equity markets throughout 2025. We believe it will drive both equities and credit in 2026, though in different ways. Alastair joins us now after a refreshing Thanksgiving break that all of us cannot relate to. But I am curious from your perspective going forward, how come you think that AI is going to resurrect that kind of lead higher, given some of the concerns that we've seen recently?
Well, I think if you look at the performance of the market this year, it's been driven by the AI infrastructure and, the AI enablers story. Going into next year, I think the big narrative for markets is how companies are going to adopt AI, and that's going to drive earnings. And so there's loads of data showing this. Some of the ones that we like to look is the Ramp AI index shows 45% of companies are adopting AI. One of the things that we've been doing a lot on is, well, what is the actual tangible cost savings from this? And so far, we think that there can be basically 1% of cost cuts going into next year. That's $130 billion. We think that can basically be saved going into 2026. And there's this amazing narrative going on right now in the market where revenue's increasing, you've got 9% growth. Actually, at the same time, companies are cutting back on labor. And so if you look at the warm data from the S&P 500 companies, it's been shooting higher. But this is nothing, absolutely nothing to do with them warning about the economy. Actually, their corporate guidance, earnings revisions are, close to all-time highs. So this almost, for me, feels like a Goldilocks scenario going with the AI narrative going into next year. And my final thing, if you have a little bit of labor weakness as a result of AI, then going back to your conversation about the Fed, might that not keep the Fed a little bit more dovish? And that, I think, again, can help support the equity market rally going into next year.
Goldilocks for the equity market, maybe not the economy, which is a sort of key distinction here. I do wonder, so this is an argument for AI being dominant, but that means the rest of the 493 outperforming, playing catch-up with the Magnificent Seven. Is that correct?
Correct. And again, one of the biggest things that we've seen over the last couple of years is that actually the performance of the Mag 7 has not been driven by valuations. It's all been by earnings growth. And now what we're seeing is earnings growth going from roughly 30 to 40% year on year into next year, probably being in high teens, and the rest of the market actually catching up with that. And so this will be one of the first years, really since 2021, where earnings growth between the Mag 7 and the 493 are going to be somewhat equal. And so I do see much more scope for, outperformance for the rest of the market.
What for you will be the telltale sign that actually adoption is underway significantly in some of these industries?
Well, to be honest, I already think that we see that. If you look at the data from some of the consumer stocks that are basically saying that we're using AI and becoming much more productive in terms of targeted ad sales and whatever else, a huge number of companies on their earnings calls are discussing about how they're adopting AI and actually, again, replacing that labor or freezing labor as a result of the higher productivity. To me, we're already seeing it from companies in the earnings calls. Now, you talk about the equity market and the economy. What's very interesting is that for the broad economy, I don't think we are seeing much productivity increase. It's really the large cap stocks. And so again, where does this AI productivity come from? It comes from companies with huge amount of employees that need to reduce it. If you're a small company and you have 10 employees, you're not going to really replace that with AI. But if you've got hundreds of thousands of employees, actually that's where the cost benefit comes from.
You mentioned that this means maybe the Fed then has to be dovish, but how could a Fed interest rate cut cycle solve the problem of AI?
In terms of, it doesn't really solve the problem of AI at all.
AI labor layoffs.
Yeah, exactly. It doesn't solve this really, but it does reduce some of the pressure on the labor market in the near term, right? In terms of reducing, credit costs, reducing interest rates, reducing some of that burden on the low-income consumer. And of course, it is the low-income consumer in particular which has been hardest hit by higher interest rates, given that they have more of their debt in sort of floating rate debt products like, auto loans, credit card loans, rather than mortgages. managers.
At this point, it sounds like everyone's banking on stimulus coming from the fiscal side with potentially $2,000 checks or whatever else comes from the tax refunds that we get in January. We're expecting monetary stimulus when it comes to Fed rate cuts, possible use of the balance sheet. I just wonder if this makes the U.S. a less attractive place on a sort of currency-adjusted basis for equities based on some of what we're expecting to see on the fiscal side.
Totally. I totally agree with that. And actually, one thing that I think the market is missing a little bit is it's not just stimulus that's coming out from the U.S. Actually, China's just done a $1.4 trillion debt swap. Germany is coming in with $150 billion stimulus next year. Japan is teeing up $110 billion stimulus next year. So actually what you could see is that we get a huge global wave of stimulus. As you mentioned, actually the dollar starts to weaken and the rest of the world starts to look very attractive, particularly because valuations are at a 30-40% discount. Even on the AI plays. You go to Asia, you got an AI discount there. In Europe, less so. But you still got places like Germany, which are seeing 14-15% earnings growth and at a valuation of 14 to 15 times earnings. To me, that seems quite attractive at this point.
So what equity markets do you like? Germany and Asia plus the United States?
So we are overweight emerging markets. That includes Asia, LATAM. That's all due to huge decreases in cost of equity and interest rate cuts. But yeah, Europe, Germany also stand out as our key overweights, and the US we're neutral on. And a part of that really is because if I was going to get my AI kind of tech play, I'd actually rather do it with emerging markets rather than the US at this point. Again, just from that valuation perspective.
Lisa mentioned what's coming out of Washington in terms of the fiscal stimulus. How are you thinking about the potential tariff impact, whether it's the United States or globally, because we're still waiting on the Supreme Court decision on the president's signature tariff policy?
Yeah, I think that is one of the aspects that worries me the most going into next year. So, the three risks, obviously AI bubble and, the Fed being more hawkish, and we kind of discussed that. The tariff one, I just don't think we've discussed it enough. I think everyone thinks that we've moved past tariffs and that's never going to come to bite. I do think there's been a lot of stocking up on inventory, and I do think we're starting to see incremental signs of inflation actually come through. We haven't had a lot of inflation data. And I suspect actually when we get it, what we're going to find is that actually, particularly on the good side, there's been a lot of pushing up there. And so I do wonder whether that starts to eat a little bit into margins. But this is where I could say AI comes to save the day. Because on the one hand, if you're a company and you're facing higher costs, actually, I think the big incentive as a company right now is, okay, why don't we adopt AI and try and reduce cost savings that way? And so much like COVID was like one of the biggest forces of innovation and adoption for companies, I actually wonder whether tariffs is one of the biggest forces of adoption of AI this year and next year, because it forces people to become more productive.
Does it make you nervous if nobody else is bearish?
I talk to people that are bearish. I think you can speak to...
Are they enacting their bearish beliefs, or they just sort of feel negative?
I think there's two things. I think the sell side, including myself, is quite bullish. I think when I speak to investors, they're clearly a little bit worried about this. I think there's definitely, every room that I walk into, it is, are we in an AI bubble? That is the number one concern. And then again, actually, this conversation about the impact on labor and, will the consumer roll over more aggressively next year is probably the second biggest concern for for investors at this point. So, do I think everyone's bullish? No, I think there's actually a huge amount of money on the sidelines. And one of the things that I think is, again, really important here is that there's $3.5 trillion of cash sitting in time deposits. Just retail investors, cash, $3.5 trillion. And as the Fed cuts interest rates, that's going to unlock a lot of that cash, which can go into the equity market still. So I still think there's a lot more buying opportunities and money to go into the equity markets here.
Stay with us. More Bloomberg surveillance coming up after this.
Ian Harnett of Absolute Strategy Research writing, America is in a race to dominate AI. We see this as part of a broader objective to boost productivity, keeping the U.S. as one of the world's richest economies. Ian joins us now, and I think that the most controversial question to you is, will it work? Is the U.S. still a bastion of returns and safety?
Well, I think, what we're looking at is an environment where President Trump is determined to win the midterms. They're going to work whatever they can do to avoid recession. I think, our chief rates economist, Ebra Harbi, wrote a great piece about Kevin Hassett. Looking at his voting profile, that potentially would lead to Fed rates being 75 basis points lower than they might have been otherwise.
This is the reason. Yeah.
And so, that's one of the things that we're starting from. Definitely recovery rather than recession, I think, Lisa.
This is the reason why a lot of people are expecting an easier monetary policy. The reason why you're seeing that baked into Fed funds futures, as well as the sort of optimistic tone for the forgotten 493. Do you think that is the right way of looking at this? That either one way or another, the rest of the universe, the equal weighted universe, is going to outperform?
Yeah, we're certainly expecting that broadening out. We're seeing that in some of the data. But the real question that investors have to answer for 2026 is this is a really unusual balance. Really strong earnings growth and expectations of rate cuts. That isn't going to survive probably the whole of the year. So is it going to be the growth in the earnings coming down, or is it going to be those rate expectations starting to get raised, even with a more dovish Fed chair, should we say?
Well, you think the AI CapEx endgame is coming? And you think there are signs of a bubble burst?
Yeah, absolutely. AI is a bubble, and so let's in terms of AI stocks, and that is going to be the problem. But why does it stop? And I think the thing that we see is that the end of bubbles typically comes because cash flows start to get strained, and that can be the cash flows of the producers themselves. And we're starting to see that cash flow headroom coming down. Our quant team have done some great work, but where we're going to see that is that it won't be CapEx that gets cut first, it'll actually be buybacks. So watch out for those. But historically, when bubbles burst, it tends to be that the people buying the goods, the services, they run out of cash. And that's going to be the thing. So yeah, AI can be a structural story, but are those banks really cyclical rather than structural?
Has it all been exacerbated by the fact that we see a lot of circular financing in this space?
This is a very classic bubble experience. So we're seeing all the classic signs. We're getting exponential share prices. The companies are using those share prices to buy each other. They're buying each other's goods. They're doing it on vendor financing. That circularity that you're talking about. And then this CapEx blowout as the cost of capital comes down for these AI companies. Everybody tries to crowd into that space. That accelerates the build out. But the trouble is the CapEx goes on like that. And if your sales just start to tail off, then the margins get hit. That's when the challenge is going to come for this market, and that's when we get more of a shock.
And this is coming at a moment where ChatGPT is turning 3. This is a reason why a lot of people are wondering, is on its birthday, happy birthday, good luck trying to survive for the next 3 years. There's this question of how much debt's been built out with data centers tied to ChatGPT, to OpenAI, incurring $100 billion of debt in that period. At what point can you see the overall market and U.S. economy continue to grind higher if you do have a busting of the AI bubble in a significant way?
I think at that point you'll be looking for those interest rates to coming down. But historically, when interest rates come down because things go wrong, that's bad news for equities. And that's the point where you could start to see the change. And that's probably going to be later in the year rather than earlier in the year. Actually, the biggest risk that we see for AI is that energy component. America has decided to use fossil fuel, hydrocarbon energy, and that's going to be expensive. Much more expensive than renewables that China is using. And it's also, there's something called the food, water, energy nexus. If you want to have more energy for AI, that's going to cost you something in terms of water, which is going to cost you something in food. Do you want a faster search engine, or do you want to still get your food on your plate? Those are the kind of decisions that we're going to see starting to come to the fore as we see more of these issues raised, I think, Lisa.
I think it's a great question. At this point, I think some people, after spending all the time on the phone, might choose their phones. I am curious, though, from your perspective, going forward, if this is the landscape, do you think that the chance of a negative return on the S&P 500 or the NASDAQ next year and a more negative economic outlook in the United States looks more likely? Because that seems to be what you're describing.
I think when we go into 2027, then it gets much more cloudy. You have to take that decision about higher rates or lower earnings. The big thing that we can see is that short term, these markets are being driven by momentum, they're being driven by liquidity, they're being driven by algorithmic trading. Longer term, what we know is that valuations matter. And so we just published a report recently about the lost decade for investors. If you are really investing for the long run, your long run earning equity returns are probably about 3% over the next decade. That means you're going to get most of your returns from income, not from growth here. And that is going to be the biggest challenge for investors. So recognize this is a trading market, a momentum market, and AI is a big part of that. Investing for the long run, that's a difficult game. Let's go back to 2000. It was the digital age. We're living that digital age today. The big players today are the big players that they were there. Microsoft, Oracle, Apple. All of those companies lost between 65 and 97% of their value, their peak value, and took between 5 and 13 years to regain that value. Digital, it was the structural story. AI is a structural story, but there's the right price to pay for everything in the equity market.
Can we put two of your thoughts together, that the Trump administration is not going to want to see a recession before the midterm elections, and this idea that you think the AI story is starting to fade?
Yeah.
How does the Trump administration make sure that the AI story does not fade before the midterm elections, given how much of the equity market is propped up by it?
So I think you've got two levers that you can, or a couple of levers that they can operate through. First of all, Secretary Bessent made it very clear that he's very, very keen to keep rates as low as they possibly can. So whether that's the new Fed chair, whether it's using stablecoin to try and inflate demand for bills or redistribute the demand for bills, then that will be one mechanism. What they have to do is to reinflate assets across the economy. The household sector needs to take on leverage. The corporate sector needs to be encouraged to take on leverage. That's the way you get the debt back under control. So what does that mean? They're going to be pumping the housing market. They're going to be trying to unlock. There's $36 trillion of positive equity in housing that can't be accessed at the current time. Assumable mortgages, something like that. Some kind of innovation, privatization of Fannie and Freddie. Those are the kind of things I think we'll see open up. The other thing is crypto. They will continue this willingness to lend against crypto, to keep the economy going, and however they manage that, then we'll see.
Stay with us. More Bloomberg surveillance coming up after this.
Private credit concerns continuing to weigh on investors, even as losses from defaults are staying low. Amanda Lynam of BlackRock writing this: "We believe the peak in defaults in the public credit market is behind us." Amanda joins us now. Amanda, thank you so much for being with us.
Thank you for having me.
This is the big question, right? How much are people pricing to perfection credit at a time when potentially defaults are going to inflect upward? There's been a lot of debt issuance in the tech space, and there's a feeling that private credit has gotten a little bit heady.
Okay, so I think there are a couple things to note. One is we often get asked in the corporate default market or corporate credit market when the peak in defaults is actually going to arrive. And what we point investors to is the data that actually shows in the leveraged loan market, for example, defaults peaked in November of 2024 at 7.7%, which is actually a fairly high number. That's using Moody's data, issuer-weighted trailing 12 months. But the point is that we think the peak in trade policy uncertainty is likely behind us. We think the peak in growth concerns is behind us. And we think the peak in debt service cost headwinds from higher interest rates is behind us. So when you put those three things together, coupled with a good enough growth backdrop in 2026, it's hard for us to envision a new peak in corporate credit defaults. And again, keeping in mind that we've already had kind of this flush in 2024 because of the high borrowing costs. I think coupled with that, our view for corporate credit, both liquid and private, is one of dispersion but not widespread market disruption. And I think that's really the key point to keep in mind.
So a positive outlook, a constructive outlook, as long as you're careful and you don't get some of the bad stuff. A real question, though, about just the spreads are pretty tight.
Yes.
But you have had a pretty loose market.
Right.
And there is a feeling that maybe the appetite is waning for some of the tech-related debt, in a sense that maybe things have gone a little bit too far too fast.
It's a great point. Our view on credit is that if you're owning credit, you should be owning credit for income and yield, not necessarily because there's room for spreads to move materially tighter, and actually not because because we think intermediate or long end rates are going lower. So that's really the view. That's a different way of thinking about credit versus past regimes when you had kind of a total return boost from tighter spreads and lower rates. It's really that income component. I would say to your second part of your question, we're not really seeing on the ground that appetite is waning to a large degree in credit. In fact, a lot of these episodes of widening, and by the way, we think episodic volatility is a feature, not a bug of this market, but those periods of episodic widening, they're getting bought. And so where high yield spreads are actually back below 275 using your Bloomberg index. So it's really to us, I think, pretty evident that there is a fair amount of capital on the sidelines. It's income and yield based. There is demand. And I think while spreads are tight, our view is that the bar for a sustained sell-off in credit spreads is also quite high. To get that, you would really need a severe deterioration in the growth backdrop, and we're really not seeing that, which goes back to this point of there's a lot of dispersion. There will be winners and losers. Not every part of the credit market is keeping pace with this tightening, but we don't see an environment of widespread market disruption.
When you look at the uncertainty, though, you named policy like tariffs uncertainty being one of them that you feel like you're past. Does it bother you that we still don't have a decision from the Supreme Court on IEEPA?
I think our view is that if the Supreme Court does strike down the IEEPA tariffs, that the administration has been pretty clear that they have other tools in their toolkit, such as sector-specific tariffs. So our view is basically that tariffs in this regime are likely to remain in place in some form. The key question is, are corporates adapting to that? And actually what we see in the margin perspective is that actually margins are holding in relatively well, and corporates have been forced to find other ways to protect their bottom line, whether that's through operational efficiencies that were originally supposed to take place over a couple of years. Maybe they're front-loaded, changing product mix, eliminating some SKUs. So it's really a bet on the management teams to figure this out, just like during the pandemic. The trend of corporate resilience was actually much more pronounced than I think many market participants feared.
There's a fiscal side of this and the administration side of this, and then there's the monetary side of this. And we've been talking about the expected rate cuts coming this month as well as potentially next year. And you said that you do think that some of the peak rates and peak uncertainty around that has faded. At what point is that sort of a necessary ingredient for your constructive outlook on credit next year?
Sure. So I think our view on the monetary policy path from here is that there's probably one or two more rate cuts in the pipeline. But as we get closer to neutral, and Chair Powell has said we're probably already at the high end of some estimates of neutral, that will become a more delicate balance between their dual mandate. And so really what we've been emphasizing is the depth and the drivers of this rate cutting cycle are far more important than the timing of this. And if the drivers of the rate cutting cycle are driven by a significant deterioration in the labor market, that's not a great outcome for credit. By contrast, if the drivers of the rate cutting cycle are ongoing improvement in inflation, then that's a more benign outcome for credit. That said, it's hard for us to see rates going below neutral. We're expecting a normalization of monetary policy, not a sharp easing. So I think that income play on credit remains intact to a certain degree. It's moderated, of course, from the peak as rates have come down. But again, that's a double-edged sword. The yield backdrop for investors has moderated, but so too, there's been some relief in debt servicing costs for corporate borrowers, which is important.
You were talking about being selective, and I do wonder, happy birthday, ChatGPT, third birthday. We should just touch on how much debt has been issued from the tech giants. We have seen $100 billion of debt tied to OpenAI and data centers that do provide services to them over the past number of months. I just wonder, does that make you nervous? Does that make you want to stay away from that debt as a potential pothole in an otherwise pretty bright backdrop?
So I think we view this as a bit of a regime shift in terms of the leadership of issuance at the sector level. As you noted, technology issuance actually months ago outpaced all other full years on record in the US IG market. So it's been kind of a real paradigm shift in the way that the market is absorbing tech issuance. We think there's a lot more room for this to play out. Actually, if you just look at a very modest estimate of increasing gross leverage by half a turn for the Mag 7 ex Tesla, so excluding autos, there's hundreds of billions of debt capacity that could be added. So that's a large amount of debt, actually upwards of $400 billion. And again, a modest tweak in leverage. We don't expect all of that to be used immediately. We think more likely it will be gradual over time. But I think the market is adapting to a realization that tech will be a larger contributor to issuance. But again, the demand for this has been very robust. And I think just like in sectors like biotech, where there are drug discoveries that happen years after bonds mature, it's almost a similar bet on the management teams.
So you'd be patient. You'd be buying.
I think from our perspective, we think that this is actually a regime shift that has been met with a significant amount of investor demand.
Stay with us. More Bloomberg surveillance coming up after this.
Shoppers spent billions on Black Friday and could break Cyber Monday records today. Louisiana Senator Bill Cassidy joins us now for more. Senator Cassidy, thank you so much for being here. Can you square this idea of incredible spending and the ongoing American consumer continuing to uphold the underlying economy and this real feeling that cost of living is becoming unsustainable?
Well, there's obviously segments within our society, and there's a group of people who are still managing to do well. There's another group of people who are really hurting. Now, they may have the money to go out and buy their children a gift for Christmas. On the other hand, there is an increasing cost of insurance, whether it's health, property and casualty, or flood insurance, as well as the increasing cost of groceries. They have extra money, but up here, but there's a lot of folks down here who are hurting.
This is the reason why a lot of people are expecting, even though we are seeing profits at companies continue to increase, they're expecting the Fed to cut rates to respond to that K-shaped economy or the mass of people who really aren't feeling the gains. And I'm just wondering how much you're prepared to step in, that you think that it's government's job on the fiscal side to really support that lower tier of consumers that are really feeling the pain.
I would argue that in the tax cut for working families, or the one big beautiful bill, we attempted to do that. We did it both by no tax on overtime, no tax on tips, for seniors eliminating the tax that most would pay on their Social Security, but also putting in some pro-business efforts that would encourage business to reshore, to build out their manufacturing. Lastly, I will say, there's a lot of money taking place on infrastructure right now, and that infrastructure creates jobs. AI cannot swing a hammer. And so AI is not swinging a hammer. Those folks are being employed. I would say that there is a business strategy to help those folks who are in the kind of struggling area of the economy.
Senator, there's one area when it comes to affordability that actually might become a lot more expensive next year if Congress does not act, and that's the enhanced premiums when it comes to the Affordable Care Act. You have a hearing this week regarding this. Do you think we can get to a decision before the deadline?
Yeah, I think we can. I have a plan, but it's one that other Republicans have proposed some form of. And we take that enhanced premium tax credit, and instead of giving it to insurance companies where they take 20% for profit and overhead, we give 100% to the patient in the form of a deposit within a health savings account. This allows her not to buy the more expensive silver plan, but to also get a cheaper plan called the bronze plan. Now, did I say it's cheaper? It's cheaper. And so we're helping her on her affordability. By the way, the money in her health savings account also gives her first dollar coverage for her child's trip to the ER. You know, I practiced for 20 years as a doctor caring for the uninsured and the poorly insured. I learned that if you give power to the patient, you can lower healthcare costs. So we're giving power to the patient, not profit to the insurance company.
Will Democrats come on board with this plan? It doesn't seem like they're interested in this. They want, at minimum, an extension for a year or two of the extended premiums.
So think about it. We would actually be, if you will, in one sense, extending the enhanced premium tax credit. But instead of giving 100% to insurance companies, they take 20% for profit and overhead, we're giving 100% to the patient. So you're getting an extension.
But the pool shrinks that money. So
no,
those that are on the higher end.
Shrink? It does not shrink.
Well, for the insurers, are they going to have to pay more? Are you going to have to say you're on, say, the premium plan? Or is your plan going to be even more expensive because it's not being subsidized by those on the lower end?
No. Again, going back to this, if you got this amount of money, and currently under the current plan, you give 100% to insurance companies and they take 20% for overhead and profit. Instead, you give 100% to patients in terms of deposits within a health savings account. First, you're lowering their deductible, and because you have lowered their deductible, they can take a cheaper bronze plan. Now, normally you don't because your deductible is higher. We just lowered their deductible. They're getting a cheaper bronze plan. By the way, when you give power to the patient, she gets the health care she chooses to have that she knows she needs, as opposed to the health care the insurance company permits her to have. A lot of wins in here for the patient. Who would not be for that, whether you're a Republican or a Democrat?
Do you think that this is enough to prevent the government from shutting down again in January when this comes back up?
Absolutely. Why? Because we've actually addressed affordability on the exchanges. I would argue we also begin to address the overall increase in healthcare cost. When you give that woman, and women make all the decisions in healthcare, when you give her the power of the purse and you say, listen, if you go here, you save money. If you go there, you don't. Everybody begins to lower their cost to where they can attract her business.
You said something earlier that I think is really important. You said that businesses have a role in creating jobs and creating a better landscape for the lower quartiles and deciles of the U.S. economy and the U.S. earners. I just wonder what policies you think need to be implemented to do that, because right now it doesn't seem to be working.
Are you talking about in terms of overall business
development? Overall business, yeah.
Yeah, so I think that the tax policy that we've put in, and frankly with President Trump's tariffs, there's an incentive for people to begin to reshore, certainly nearshore. And so when you reshore, you're going to create jobs. Now, that doesn't happen like that. Think how long you need to put together your financing stack. But that's going to happen. And so as it happens, we'll see that kind of upswing in jobs for construction, for service, all those jobs that are related to that reshoring of manufacturing activity. And that'll cause a general boom. So that is a sustainable strategy to create prosperity for folks.
A lot of people are saying that the reason why companies haven't created more jobs is because they're using artificial intelligence for efficiencies. And you're seeing that in terms of Amazon coming out and saying they're laying people off because of some of the efficiencies they're getting from algorithmic learning. I'm just wondering, from a legislation standpoint, what you think that the government's role is in trying to make sure that people aren't left behind in this transition, given that a lot of these new programs can take on roles previously done by humans.
I'm a technical optimist. If you've got something that's going to increase the productivity of our nation, we'll increase tax revenue not by increasing rates, but by increasing the overall growth of the economy. When you increase that overall growth of the economy and you have more money, we've got like trillions of dollars of backlog in infrastructure. Let's just focus once more there. If you begin to invest that money in infrastructure, AI does not swing a hammer. You're going to create a lot of jobs for folks who right now are struggling to get better jobs. By the way, we're also building out our oil and gas industry, our energy industry. That creates a heck of a lot of jobs. And so everybody looks at the negative, oh, we're going to downside. We need to look at the positive. That will just shift investment to a more productive area of the economy. As we grow at the expense of other nations, or maybe we all grow together, we'll create that employment.
Lisa started out this conversation talking about affordability. Americans are still struggling. You're also looking at trying to address healthcare affordability by actually having this health savings account proposal. The president talked about $2,000 tariff checks. You're on the finance committee. You lead the health committee. Do you think that that is a good way to address affordability right now, putting money directly into consumers' pockets?
So I'd like to see what the president's going to propose. We do know that the debt and deficit eventually takes money out of our pockets. And so we absolutely know that. So the question is it better to pay down our nation's debt? And as you pay down our nation's debt, then it makes it easier to lower interest rates, for the Fed to lower interest rates, which then lowers a mortgage payment, which then maybe lower other forms of credit. As you do that, you make life more affordable that way. The other thing you have to worry about is if you give everybody a $2,000 check, does that bump up inflation, and therefore the Fed is inhibited on lowering their rates? So it can't be taken in kind of isolation. It has to be taken in context of everything we can do to benefit that person sitting at home struggling a little bit.
It sounds like you would be a no then on the $2,000 checks.
No, it sounds like I'm going to investigate so that I know.
Okay, while you investigate, there's also potentially going to be another big Senate, first a hearing and then a vote when it comes to the president's Fed pick. Right now, the front runner is his Council and Economic Advisors chair, Kevin Hassett. Do you think you would say yes to him being the Fed chair?
I've been impressed with Kevin. This is the second time around serving in Trump's administration. I think he's done a good job. Of course, I reserve judgment until we actually begin to look at him as Fed chair. We are having this problem of inflation, which just is a little bit sticky, and yet we want to decrease rates. How are you going to navigate that? But I'm certainly predisposed to support him.
Are you worried about Fed independence?
Fed independence is critical. You just have to have it. But I also think that Kevin would step up and be as aware of the importance of Fed independence as anybody.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.